On the line with me this morning, I'm fortunate to have my guest, Robert Creamer. Robert is with CMO Commercial. Is based in Austin, Texas, and CMO Commercial is a division of Keller Williams Commercial Real Estate. And he's also a new father. And Robert, welcome to the program.
Hey, thanks so much for having me. I appreciate it.
Yeah, man, I feel for you, and or actually, congratulations on your your new family addition there. And like we were talking before the call here a little bit, the sleepless nights there of newborn, but you'll make it through. I've been there, so
Yeah,
congrats.
everyone keeps saying once you pass 10 pounds, they start sleeping better. It becomes easier. He's at 11. He slept 8 hours last night, which was that was the first and longest stretch we've ever had. Usually it's 4 and 5 hour breaks. So, but it's exciting. It's all
No,
new.
well there you
Big
go.
adjustment.
You got 8 hours last night, so that's great.
No, I had 8 hours. He did.
Yeah. No, you got to sync your sleeping with him. You know, it's time to go to bed at 8. You know, and 8 and wake up early there. But
Last
that's
night was 8 p.m. to like 4 a.m. So,
gotcha. Well, hey man, before we get going here, if you could tell the listeners and help me understand a little bit more about you. I gave just a very brief introduction there. Tell us a little bit about you and take a minute and fill in some of the details.
sure. I was born in Dallas, moved to Austin when I was 4. Went to a quick 3-year stint in London for my parents' company. Came back to Austin for high school. Went back to Dallas for college. I got a real estate degree from University of North Texas. Started doing commercial real estate in Dallas. Then moved to Austin to start the commercial division at the Northwest Market Center for Keller Williams. We had great success there. Right now, we're focused on expanding our CMO team across Austin and Dallas, and then we're going to expand out hopefully to 10 market centers in the next several years. So we got some big goals, but I've been in commercial real estate since college and I love it. I'm a lifer.
Got it.
And yes, I did just have a kid. So we do have a 7-week-old as of today, and that's an exciting challenge.
No, that's that is an exciting challenge there for you, and I say it with uh, just complete conviction. It's the best thing that ever happened. Getting married to my wife was good, but the kids, it's an interesting. It just kind of puts all of life in perspective there, and wish you great success with that.
Well, thank
And
you.
so let's kind of get into this. What you and I were talking about here a while back, and had hoped to put this together here was kind of the mindset and kind of the what somebody needs to do when when moving from single family real estate into commercial real estate. And I think most people that I know, when they think of if they own a home and they think of real estate, they may think of like having another a rental or a single family, which for the most part, if you qualify to buy a home, and you need to go or you're going to go buy a rental house, you're going to qualify, the process is very similar to what it was when you bought your house. Lender's going to look at you. The market is going to determine the value of the house based on square footage, neighborhood, what the neighbor's house sold for, etc. But commercial is a little different. And you being in a commercial world, I was hoping that we could get into a conversation about what you see as the difference and what's kind of key for people when they're making that move from single family into commercial.
Well, the main thing is just getting your knowledge base. I mean, most of the people, if you ask them why they choose residential investing, is because it's comfortable. We've all lived in a house, we've lived in an apartment. We know the mechanics. If the hot water heater goes out, we know we got to replace it. You have to change the AC filters. You know how the loan works, or at least you pay rent. You got to pay taxes and insurance. I mean, the mechanics are pretty simple when you look at buying a single family house, or even a duplex. It's basic. We get it. It's comfortable, right? There's not a lot of fear. When you look at commercial real estate, people act out of ignorance. They just don't know. And I asked, I don't know, probably 50 people over the past year, why do you choose residential? Have you thought about commercial? And the overwhelming response was always, I don't know commercial, right? So people aren't taking the time to go out and look into commercial real estate. They just see it as just the shadow, so to speak, the gray area they don't want to play in. And the fact is, there's some fantastic opportunities in the commercial world where if you just educate yourself a little bit on the mechanics of some of them, you can see some great opportunities in your market center, in your market area. Um, I'm not saying, because residential investing is a fantastic thing to do, regardless of what you choose to invest in. Building up your wealth, building your passive income stream is what everybody should be doing, and as fast and as early as possible. So I applaud anyone who is investing, period. I'm just saying, let's open the doors a little bit. Let's look at commercial real estate. Let's see what the opportunity might be, whether we have to do it ourselves, partner with an investor. Does it make sense? Does it not make sense? At least educate yourself to make that decision.
Right. Well, let's talk a little bit about maybe the difference between a residential and a commercial deal. Talk about educate, and consider the options. If somebody was considering a single family, kind of like what I laid out, I mean, it's very similar to buying a house. If someone was wanting to get into commercial, what's one of the first things they need to know? And maybe this is a way to look at this is before somebody is to go out into the commercial marketplace and look at potentially investing in commercial, what are some steps that they should take before they get into that?
Well, the first step, and always a good step, is one of two things. Go talk to a commercial lender, and they're going to explain everything you need to know about the lending side, what you can expect based on your financials, what they're seeing in their marketplace. And the second thing would be to go talk to a commercial real estate expert, because they're also going to be able to fill you in on, okay, what does the financing look like in our marketplace? If I go to my local bank, what is their fairway? What are they going to want to invest money in? And most of the time, the local banks are going to invest in owner-occupied type of products. So talking to the bank is really going to give you an idea of what they're willing and not willing to do. And then talking to your broker, your real estate broker, will tell you, okay, well, that's what they're going to do. But if we go talk to these people, this is what they can do. And this is why you should invest in this market. This is why you shouldn't. They're going to tell you the ins and outs. So those are the two things everybody should do first.
Okay. So somebody goes to the bank and they get kind of the 1, 2, 3 from the bank as far as what they are potentially capable of doing. You go meet with a broker. Then at what point does the focus on the opportunity? Is it are you saying the result of what the conversation with the bank will kind of dictate what the lender or the broker can point one to, or what do we?
Well, that's just to give, if you're hesitant, if you're thinking about it, if you haven't committed yet to jumping into the commercial real estate world, that's going to give you a good knowledge base. You'll understand what you might be getting into better, what everyone should be doing. Get a good knowledge base of why the opportunity could be there, and then build your knowledge base so you feel comfortable. Otherwise, you're really relying or putting all your trust in a broker, which is great. We love when people trust us 100%, but we want them to feel comfortable. We don't want them to always be asking questions and worrying. So the more knowledge they get, the better. And as soon as they get a knowledge base and they say, you know what, there could be opportunity. Can you show me a few opportunities and why it's a good fit? And that's what we do. We send them an email. We follow up and say, take a look at this. This is why this was a good fit. This is why it wasn't a good fit. Whether it's on the market or not, we can at least show them a few opportunities that have come across our doorstep and show them why they should look at things such as this.
Got it. So I want to drill down a little bit on you as a broker, somebody new coming to you. Give me the difference between somebody that you're going to invest the time with and try and get them, try and help them, as opposed to the one that calls that you're going to, oh boy, because I think that part of that education process is. Somebody goes and reads a couple of books, they maybe have a couple of conversations, think they know what the world's about, but I've talked to a number of brokers, and there's without stereotyping, an industry. I think it has a reputation as kind of an old, good old boy, as kind of a network from a standpoint of, as opposed to like real residential, kind of the MLS where all the information's out there. Brokers have a different kind of, a way of operating. They have their trusted investors that they know are buyers, and they're going to try and feed those guys, opportunities first.
Yes.
Can you help the listeners understand what would put them in a position and impress you, a broker, that this person's for real, this person's going to do something. Let's see what we can do to help you.
Well, I'm glad you brought that up because even one of the problems or the obstacles that we have as brokers in the commercial real estate world is getting calls back. I mean, the commercial brokerage community is well known for not returning calls timely, not dealing with the mom and pops who want to jump into commercial real estate. They want to focus on their high profile clients, the hedge funds, life insurance money, the big clients. Most of them won't give you a time of day if you're looking at, hey, I want to invest $500,000, which is, it's an obstacle for a lot of people. So we wanted to set up a team environment where we have seniors who are handling the larger transactions, but we also have juniors and junior associates who are coming in who are more than happy to handle the first time investors, tenants, you name it, come in, and we can show them the ropes and walk them through all the steps necessary to get them to where they want to be, which is you don't see that in the bigger firms. It's just they want to deal with the big boys and they want to play in their own little sandbox in the backyard, and we want to open the doors up to everybody. We really want to come from a servant's heart and say, look, how can we help you reach your goals? Because what we like to ask people is, what's your end game? Why are you doing this? And if we know why people are doing this, we can help them with the process. Well, actually, this may not be the right way to do it, or this is the right way to do it because this is what you're trying to get to. Let us help you get there. But as far as who our ideal client is or who we would be more than happy to take the phone call is really anyone who wants to invest in commercial real estate. The biggest hurdle we have is when we have out-of-state people call with unrealistic expectations. They call Texas, Austin, Dallas, and they say, hey, I want a 12% return. And we have to say, look, right now in our economy, this is vastly, there's zero opportunity for you in our marketplace. And they don't get it. And it's like, well, what do you mean? There is nothing anywhere close to a 12% return. We have to have a meeting of the minds. And when we can overcome that and we say, this is the reality of our marketplace, can you play in that world, or do we need to wait or move you to a different sector of real estate, different city, different state? Where is your end game going to be? Because it may not be Texas.
Right.
We really are.
So when somebody calls you and they've got like the $500,000, what could you expect? I mean, as far as if somebody was looking for, what is the market returning right now? Can you give some sort of what would be the maximum opportunity for a purchase if you had 500,000? I mean, is it a 25% down kind of a market with it? Can you walk through a little bit of
that? Yeah, generally speaking, the lenders are 25% down. So if you have $500,000 cash, we'll ballpark the $2 million range. I'd say $1.5 million to $2 million, you're in the safe zone. With that, you can buy a smaller multifamily transaction. You can buy some small retail, some smaller office. Everything's going to be a little bit smaller based on the price per square foot we're seeing right now. And the returns have been pushed down along with prices going up pretty considerably over the last 3 to 5 years. I mean, it's pretty remarkable what we're seeing in Austin. Dallas is not quite as expensive. It's probably it's a different environment to invest in. But as far as cap rates go, we just closed one at a 4% cap, if you can believe that. But most of the stuff we're seeing is probably in the 5.5 to 6.5 range. And then if it's Class C, meaning it's older, lower income families, lower rent, we're seeing you might be able to get over that 7% marker, but not very often. Even those right now are trading to 7 or sub 7% returns.
Got it. So are the rent increases, I mean, and let me back up for 1 second. Cap rate, just as a measurement, is it fair to say that's reflective of the demand for the product, meaning that the reason why the returns are so low is that there's so much demand for the product?
Yes. I mean, they're especially in Austin, there's a huge lack of opportunities to invest in, and there's a ton of buyers wanting to be in Central Texas. So it's making the prices go up, cap rates are being suppressed, and all a cap rate is a snapshot. So if you invest at 100% of your capital, your cash, that is your return on your money. So if you
Right.
leverage it, that changes. The real trigger would be look at your IRR, your internal rate of return over, say, a 5-year hold or whatever your exit strategy is. Yeah.
Right, and I think sometimes it people focus on just the cap rate, not realizing the exponential of that lower cap rate. Further down the road, you're probably getting higher rent increases. Is that fair to say? I mean, in a
Yeah.
tight market where there's a lot of demand for the product.
Yeah, when the market's hot like it is right now, all the leases turn to what's called a triple net lease. So instead of having a gross lease like your residential, where you have, let's say your rent is $1,500 a month, on your single family, that covers everything. The owner has to pay all the expenses. Well, on a retail, office, or industrial lease, right now everything's trending in the triple net arena, which means you're not only paying a base rate to the owner, but you're also paying the triple net charges, which happen to be taxes, insurance, and common area maintenance. So you're paying all of the fees for the owner. So if taxes go up, the tenant has to cover it. So as an owner, it's great if everything goes up. They're covering all of your expenses, which is a phenomenal position to be in. But when the market softens up, everything slowly starts trending back to a gross lease.
Right.
And right now, a lot of the times when the market's soft, we'll see a 5-year lease where the rents are staying flat for 2, 3 years at a time, and then maybe have a 50 cent or a small increase. Right now, it's 3 to 5% annually increasing.
Wow. 3 to
Yep.
that's big.
Yeah.
And following that cap conversation though, so if the market, the demand is high, the supply is low, the cap rates are low because of the demand, right? I mean, you just can't get as much return on, cash return on your cash. But if the cap rates are low like that, and you're exiting in 5 years, I'm assuming that you would, provided cap rates stay low, you're going to benefit significantly on the sale price. Would that not be accurate? If you had a, is that, am I saying that right?
Yeah. I mean, if you have 3 to 5% increases and you have a large enough scale, then absolutely, you can see some pretty big returns if you have 5% increase over 5 years.
Right,
Yeah.
right. As opposed to if there's a lot of supply and no demand, or not as much demand, you get a high cap rate. You're going to get some, cash flow, but the because there's not the demand driving the valuation, you're not going to have the increase in the value uh, as rapidly. Is that fair to, am I summarizing that?
Yeah. I mean, depending on what state or what market you're in is going to dictate also a lot. I mean, right now in Central Texas, as many people as we have moving here, we don't see this slowing down anytime soon. At best, or worst case, it'll flatline. We have so much growth and activity and headquarters moving into our cities that rents are going to continue to go up. More households are being developed. I mean, just where I live in Dallas, there's 4,800 new houses being developed on one road. I mean, it's crazy. There's at the 121 and the Dallas North Tollway and Plano Frisco border, there's 22,000 new jobs being brought in within like a mile radius.
Wow,
It,
that's
it's,
that's
it's
strong. What's the median income?
depends on where you go. I mean, the farther north into Plano Frisco, where this is, it's kind of in the hot spot of Plano. So the median's over 120 and $130,000.
The median income is at, wow, wow, that's huge. Um, well, so if you were to give an investor some advice that was wanting to get out of the single family and get into commercial, what's what's the first thing? I mean, we talked about getting in having a conversation with a bank and meeting with a broker, but is there any one thing that you would say, before you do that, do this?
It's a lot of the times we want people to look at their risk tolerance. Okay, what are you willing and not willing to do. How much do you want to stretch this? It's kind of like, would you put all your fund in, say you had $100,000, would you dump it all into one stock, or would you go to a mutual fund and spread it out? You know, where is your risk tolerance in the game of real estate, period, passive investments? What is your end game? We have to figure out why you want to invest. If you want to invest to build wealth and build your cash flow for your future, that's one conversation. If you just want to invest because you like playing the game, you know, that's a different story, right? We can let's put all the chips on red, right? So it all depends. But regardless of who you talk to, when you talk to them, if you're not looking at transactions, you're not going to get it. So whether you talk to a bank or a broker, take the time to ask to see a deal. If they'll share one that's already closed, fantastic. If it's on the market, fantastic. But look through it. Look through the financials. Look through the risk. Look through the expenses. Does it make sense to you? What doesn't make sense? The more transactions, the more deals you can get in front of your eyes and review, the better you will be when the time comes to pull the trigger.
Now that is kind of math 101. It's kind of the whole repetition of doing your homework kind of thing. I teach my kids. That's what math is you do it and you do it and you do it so that you know it.
Exactly.
And it then you're comfortable with it, and you can recognize the opportunity, or possibly where something's out of skew, or something that can be changed, or at least enough to know that maybe there's a good question to ask a broker or a banker. This doesn't seem, does this seem high, or something like that.
Absolutely. Yeah, we see the biggest jumps in wealth with people who are investing in commercial real estate. I mean, period. So, the second you cross over 5 single families, your whole lending environment changes, because it's hard to package residential together, because then if you can't sell one off, so it makes it difficult. In the lending industry said, once you have 5 or more, everything changes. On the commercial world, it's a lot different. Like you mentioned earlier, they look at you if you're buying a single family. On the commercial side, they're going to look at the asset, the tenant, the cash flow over the borrower, and the borrower comes second. So it's a different world. But from the people who have changed and made the jump from residential to commercial, that's where we see people really taking huge strides in their asset base and their wealth growth. So we love it. I'm in for life. Like I said, I love this industry.
No, I think that is a point worth reiterating. And call me the slow ski kind of guy, but it took me a while to recognize that, because it's if you're used to borrowing, to refi your house or buy a house or whatever, you understand they want to see all your tax returns, and it's all about what your W-2 is and what your income, and because they want to know they're going to get paid, because you are the one they're looking for. You are their tenant, if you will, from a standpoint from the lender's perspective. But on the commercial side, like you're saying, I mean, it's a entirely different thing when they stop looking at you and they start looking at the property and the tenant and the operations, and what kind of and maybe you could speak to that just a little. What's an underwriting standard that a commercial property is going to underwrite for? So if you have and this goes straight to the valuation of the property. Can you speak a little to that?
But yeah, when I first got started, I didn't understand it as well as I do now. But when people ask me, we have people buy these large assets, and one time I had a borrower looking at buying a $10 million asset, and I was excited, right? Wow, this is amazing. This is a great opportunity for him, for me. I love it. So I'm digging through all the numbers, and I asked him, I said, "How are you underwriting this?" And he said, "You know what the nice part about these big transactions are?" And I said, "What?" He said, "The money's never stupid." And I thought, I'm like, what does that mean? And so I asked him, and he said, "Well, the lender underwrites this to the extreme, probably more than you will. Then their attorneys review it. Then the title attorney reviews it. Then the seller's attorney. Everybody has eyes on this. It's not buying a house. This is buying a cash flowing asset with a lot of moving parts, long leases, and the underwriting is a lot more extensive, because there's a lot more things to take into account. Like when you buy a house, you have your basic expenses that you understand. Well, on the commercial side, some of these leases are 20 to 60 pages long. You have a fire riser room. Okay, what is that? You have a flat roof versus a pitched roof. You have so many more different things to worry about that the lender is not going to put themselves in a vulnerable position if they don't have to.
Right. No,
Yeah.
that's an excellent point. I mean, that's kind of that. You've got people checking your work, and they're not, like I said, they're not going to do something stupid. It's a lot to put out there, and to have that kind of a second, third, and fourth set of eyes checking your work to make sure the deal makes sense. I think
Yeah.
it was Grant.
Not to say
Grant,
that, it's not to say that a bad deal can't happen because the banks, they're hookers like everybody else, right? They want to get deals done. They want to make money,
right.
but sometimes they get overreached. Like we just closed a transaction in Denton, Texas, and I think it was like 2.8 million dollars. And frankly, if I was a lender, I wouldn't have closed it. There's too many red flags. The leases were too short. The owner had made some promises to the tenants that he didn't do, and now I'm having to come in as the property manager on the backside and help clean up a mess and make sure these leases get renewed. There's like 3 out of 4 leases coming due next year, and that's it was pretty risky from the bank standpoint for them only to be getting 25% down. So they got it done, so it can still happen, but the likelihood of a big mistake happening is severely minimized. And again, it goes back to your risk tolerance. How much risk are you willing to take on yourself, right? If you have 3 out of 4 leases coming due in a year, okay, how's the market in that environment? How many vacancies are there? What's the likelihood of more people, more retail, more office coming in that's going to make us sublease or release this opportunity? So we got to look at all that because it's not just black and white.
Do you think in this situation, like you're describing, that the bank was considering just kind of the cap rates and the demand for property? That does that start to influence their underwriting guidelines at all?
Yeah, if you're a local versus a national bank, yes, 100%. I mean, if you're Chase or you're Wells Fargo, they have their fairway. What they like to invest in is owner occupied, at least 50%. We love it all day long. Once it deviates away from there, it's in a gray area. It's hit or miss with them. It really is. So the local banks, because they have the national level, right? On a national level, the hotel industry is only doing it's at a C level. Yeah, but in Austin, it's at an A plus plus, right? So if you go to a local bank, they get the local market. They'll probably give you more favorable terms because they understand how the market's doing, and their underwriters are in that local market. So the lending can play a big role. So most people do not go to their big banks unless they have a huge portfolio at that bank. Then the bank will probably turn a blind eye and say, you know what, we like you so much, this deal's not terrible. We're going to go ahead and take a chance because we know you're good for it.
Right. Well, and just like you were describing, kind of the demand for product earlier, and it's like you said, there's a bunch of leases that are coming up all at the same time, and but I'm just wondering, I think there's all sorts of talk, and who knows? Nobody knows until it happens. For the most part, I mean, it could be a major event that all of a sudden shakes the market, that all of a sudden everything comes undone. But in the main, I think everybody they take into consideration all of these factors. You've got this demand, which is suppressing the cap rates, the rents are going up, valuations, etc. And like you said, it's not that a bank can't make a bad loan, but I think that like you said, in commercial stuff, they're looking at all the information. It's not just you and your work and where you work and how long you've been on the job and getting a letter from your employer saying, yeah, Robert, yeah, he does good work. We're going to keep him, kind of thing. So it's there is some, it's just there's some extra set of eyes. I guess is what to say there.
Well, just like you saw in Money Never Sleeps, Wolf of Wall Street says, I mean, when does the party stop? It's okay. We've been on a run for a long time.
Right.
When does the party stop?
Yeah.
And when it stop, how big of an impact are we going to have in our market, on the stock market, on the residential, on commercial? What's going to happen? And that's a big question mark. I mean, we've been on a long run, so something's got to give because when prices get so high, you're outpacing the market. In Austin specifically, we had 14% year-over-year growth for 2.5, almost 3 years. You can't keep that up. You got to stay at 3 to 5% just to maintain. So, no one really knows, but I do know for Central Texas, we have such an influx of people moving here that I don't see it doing much more than flatlining. If it dips a little bit, it might. But the difference when you look at residential versus commercial, the financing is different. We all know the residential, you can amortize over 30 years. With the commercial world, though, generally speaking, you amortize for 15, 20, 25, sometimes 30 if it's multifamily, but a lot of the times it's due in 5 to 10 years.
Right.
So that also is another risk level that you need to understand when you're investing because right now the market's hot. You're buying at a premium, you're buying at a good interest rate, but if the interest rates go to 7 from 4.5 and the market goes down, you're 50% occupied instead of 100%. I mean, you severely decrease the value of your asset.
Yeah. No, it's. I think you have to have some sort of a plan A and a plan B. I guess it's the kind of when you're getting into that, and like I said, I mean, understand your risk tolerance and know, if you're a buy and hold and what the kind of the road may present, and because it's weird. I was just sitting there thinking about back when '07 happened, '08. I had a client. They had a couple of warehouses, and there were some new ones that popped up in the area, and all of a sudden the new ones they didn't want to lose their warehouse, so they're out there attracting the tenants from the other ones at better rates than they were getting from the existing stock. So now you got an existing warehouse that's empty because he lost his long-term tenant because he probably could have worked it out, based on renegotiating the lease. I mean, you think about all the effort it takes to move, kind of thing. But I know in one case, one guy, he lost a warehouse down in California, and it was timing too, because it was like he was just like, he was so close to getting a lease signed and ended up having to let it go. But it was just kind of a crazy thing when the music stops, you gotta be able to dance, I guess. So.
It is a little bit different, and a lot of unfortunately and fortunately, I mean, if you're the guy with an existing opportunity that's been there, it's older, it's outdated, you haven't kept up the upkeep, I'll put a plug in. If you're in the residential commercial, you need to have an asset man. You need to have a manager handling your business. And the reason is just like what you said. If you're an out-of-state owner for an investment and you are not updating and keeping your property to look at least what the new stuff might be looking like, replacing the facade, changing the HVACs, redoing the parking lot, redoing the bathrooms, whatever it takes to keep up with the trends, you're going to be in trouble if a new opportunity comes in the marketplace and looks sexier and it's the same rate. People are going to jump ship, especially if the new owner is smart and he wants to buy market share. He will reduce your rate and pay for you to move, knowing full well he's got a 7-year lease. So after a year or two, you're already back in market, and then you're going to exceed where you were in the last space. So
Right.
He's going to be back end loaded to make sure his asset is the most has the most value in the back. And it's a win for him, and it's a loss for whoever's not taking care of their property.
Right. Robert, if just trying to look here on something, you talked about know your risk tolerance. I think that's a key thing for people getting into commercial real estate. Before we close, is there anything else that you could words of wisdom you could share with the audience here that considering looking at getting out of single family, getting into commercial real estate?
Well, I think the biggest thing is, like we've touched on, which we can go in, of course, a ton of detail on commercial real estate. There's a plethora of information. Unlike the single family, we have all the different segments, office, retail, industrial, land, development, all that stuff. So if I could ask anyone to do anything, would be to at least educate yourself a little bit and start looking at opportunities. I mean, just get opportunities in front of your face so you can have a better understanding of why you would or why you wouldn't want to invest. At least then you're making an educated decision instead of just saying, you know what, I just know single family. We're going to always stick our money in single family and we're going to ride that wave. And the second thing would be to know your exit strategy. Why are you investing, period? What's the end game? And how are you going to get there? Because if we know what your end game is, we can help work backwards and put a plan together.
No, that makes a lot of sense. Definitely do your homework and know your why. I like that. I like it.
And ask for help. I mean, if you contact the right broker, they're more than willing to offer advice, opinions, and share what they know. If you go to the big houses, it can be very tough unless you have $2, $5, $10 million you want to throw at them. So, just make a few phone calls until you feel comfortable. Someone who's willing to talk to you. There are out there, and there's a lot of people who can offer some great advice and really help you to reach your financial goals.
Got it. Robert, what's the best way for listeners to find out more about you or get in touch?
The best way is just email me directly or give me a call. I mean, we're very easily accessible. My email is Creamer, CREAMER, at CMOCRE.com. And that's CMO like Chief Marketing Officer, CRE like Commercial Real Estate.com. And my cell phone's 214-564-8909. I'd be more than happy to take some phone calls and direct you where we can.
Got it. And I'll list all that in the show notes for our listeners here. So if you're driving and are not able to, just go look in the show notes, and you'll see that, and can get in touch with Robert. Robert, thanks again for taking the time today. I really appreciate it, and we'll look forward to doing it again soon.
Yeah, I appreciate the time, and thanks for having me, and you all have a great rest of your morning.
All right. For our listeners, if you like the show, share it with someone you know. It's really easy to do. You can share Robert's story, and anyone that you know that's wanting to learn more about commercial real estate, this would be a great opportunity. That's all we've got for this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.